Hello guys, and welcome back to Leah's Lifestyle. We're at it again with another Rule Number 1 podcast, and today we are on number 14, how to make your first trade. We are going to get started right away. I'm just going to make sure that you guys are going to be able to hear it. Oh, no.
This is Phil Town,
And this is Danielle Town.
and we're here talking about investing and how to make money doing it Warren Buffett style.
How to
And
make
Yes,
your
we
life
are.
better by investing with confidence instead of fear.
how to have
Yeah,
money when
confidence.
you're old. How to have money when you don't have any to start with.
How to have money
That's a
when
good
you
one.
don't have
like
money
how
to start
how to get
with.
high rates of
That's
return
good.
with very low risk. Almost no downside investing. What we could call that? No
Like
downside
that.
investing.
Almost no downside.
Almost no downside investing.
It sounds
The
realistic.
98% good result.
I
Yeah,
like
sort of
that.
And we promised you guys last time we'd talk about how to get started. I mean, how do you begin? Where's the beginning and all that? Because we've been talking for lots of
Yeah.
podcasts about how it's
13
done.
specifically.
But how do you start?
Yeah, just really obvious, probably questions of, do you need an account
Mm.
to start purchasing stocks on the public markets?
Yeah.
I assume you do.
Like, how basic should we get here?
I'm talking extremely basic. I've got some other
Extremely
answers, but I've also
basic,
gotten
okay.
questions from other friends of mine of just really like, what on earth do you do? So
Right.
I'd love to go through those
Do
questions.
we need to go all the way into like what is a stock?
What is a
How
stock?
far deep into
Probably
this do we?
people, if they're listening to this, have some idea of what a stock is.
All right, fair enough.
If you want to explain, be my guest.
Well, we just in general, maybe I should just say that if you were to start a business, like let's say the
Mm-hmm.
classic lemonade stand,
Right.
you'd go out and you would need some money to get the stand and some lemons and some sugar and water and some cups, and
Mm-hmm.
you would have to capitalize your business in order to begin that. And so sometimes if you're just a kid, you don't have any money, so you capitalize it from mom and dad's money. They become investors in your lemonade stand.
Right.
And so a lot of businesses start up with what we call the 3 Fs: friends, family, and fools.
Right.
So money from the 3 Fs. You know that well, and because Danielle is an expert in
Fs.
emerging company law, and that's her
Well,
practice.
that's what I practice.
Yeah.
Which is another way of saying that.
Friends,
Fair enough.
families.
Yeah, I mean, certainly I work with venture capitalists and angel
And
investors,
fools.
which are angel investors are typically friends and family of founders of companies.
I'm
They
gonna
are
say
not fools. But you know, sometimes
angel.
also they're people who don't have a lot of experience with investing. So
Well,
that's kind
the
of that
fool's thing is
facetious
said.
way of.
The fool's thing is like tongue in cheek with a
Yeah,
lot of love.
It's a lot of love.
'Cause
It's
it's
like,
people
thank
who
you, God, for investing in my fledgling business that has no evidence it will ever
Exactly,
succeed.
exactly.
Yes,
And so this is
yeah.
typically not a public stock. This is a company that's just beginning, and it has some sort of ownership structure to it, right? And it can take various forms and so on. So,
So when somebody who's not actually operating the business then offers some money to the person who is actually offering the business, they in exchange take an ownership portion of the business.
right on. So now they got its ownership is divvied up a bit. All right, and now this business turns out to be pretty successful, this little lemonade stand, and now it's growing like crazy and throwing off regular cash flow, and they've got all sorts of growth opportunities, and the cash is coming in, but they could use more cash and put it to work
Yeah,
if they could get
need
it.
more
And
cash.
so what they might do with the lemonade stand, now that they've got a track record for several years of success, is
Several
they
years
might,
of success.
they
Whew.
have a choice of where they would get the capital.
Mm-hmm.
And one of those choices is to take the company public. That's what we call it. They go through
Public.
an initial public offering. They register the stock with the SEC, the Securities Exchange Commission, that regulates companies and brokers and selling of the stock. And it is then listed on an exchange. And as well, it's almost listed. What happens is companies like Goldman Sachs and other big investment banks and small investment banks will determine that they like this company a lot. They like the track record. They really believe in it, and they will help take this company public. And so what they do is they get a roadshow together. They
A
go out to all
roadshow.
their different brokers all over the country with the CEO and the CFO of this company. They do maybe 2 or 3, 4 cities a day, and what they're trying to do is drum up business. So it's a big sales show. And at the conclusion of this show, they start taking orders from all of these brokers who have clients everywhere. If this lemonade stand has really impressed everybody. And so they take all the orders, and they start to figure out with the company what price they're going to put on that stock. And so they decide, okay, we're going to offer out, let's say, 100,000 shares of stock or 10 million shares of stock. It's really sort of the number of shares of stock just kind of depends on how valuable the business is, because they need to have a listing typically in the public markets of about $5 a share. And so they'll say, well, this company is worth, $500 million. So we could have 100 million shares at $5 a share. We could have 50 million shares at $10 a share. We could have 10 million shares at $50 a share. Where do we want the stock price to open up? It's just how many slices are we going to chop this into? And when they figure all that out, they decide to go public. Often they go public at around $20. Is a nice ballpark number. because
$20.
It feels like a good, solid company. It's all psychological. I mean, you could go public with one share, but it's psychological, and they want enough shares out there to create liquidity.
One
in the market
share.
to satisfy most of the people who want to buy it, but not everybody who wants to buy it, because they want pressure to push the stock price up after it goes public.
Liquidity meaning if you want to sell a share, there is usually a buyer available. That
Right.
makes a share liquid.
Right. And initially,
And not all publicly traded stocks are liquid.
No, a
there
lot
are
of-
some that are difficult to sell or difficult to buy.
Okay.
yep, they've gone
Yeah.
public, and there's no Goldman Sachs investment banker really supporting the stock and ready to buy it and make the market.
Okay.
And so, it becomes really more difficult to sell and buy. And you might be selling for $10 and buying for $15. I mean, it could be a huge spread.
jump.
Yep. But And so this sort of idea of how many shares you're going to put in the market is all kind of determined by the overall value of the company and how much they want the shares to sell for in the initial public offering, and how many people are out there to buy those shares and how hot the item was when they took it around to all the brokers. And so it's a big thing. You figure it all out, and the company goes public. Now, from that point, when the company goes public, it receives the money that is put in this initial public offering. So let's say they receive $100 million. From that point, those shares trade in the public market at whatever price people are willing to buy or sell them at, and none of that money ever goes back to the company. But having a strong public market for the stock makes the company gives the company a strong balance sheet, because it can borrow money against its stock if the stock is really strong in the market, and that allows it to have good credit, and really is important for companies to preserve their sort of good credibility once they become public, for all kinds of debt reasons and obligations of the company that they can get into when they're cranking up their business. So the public markets really have a huge impact on the ability of a company to grow, because they provide capital, and then on the sort of credibility of the company as you go forward.
I did not realize that. I did not know that they first traded to the banks and to fund managers and then received all that money, and then I always thought that the money that you put into like if you bought a stock, that money was given straight to the company. I didn't realize that it wasn't given straight to the company, and that it was used more to show that they had interest and that they could then loan and ask for more money and stuff like that. So I'm just kind of writing that down so I'll remember it real quick. I just want to go back just a little bit so I can listen to what he said exactly.
Credibility once they become public, for all kinds of debt reasons and obligations of the company that they can get into when they're cranking up their business. So the public markets really have a huge impact on the ability of a company to grow, because they provide capital, and then on the sort of credibility of the company as you go forward, and whether the market's real strong. So that's kind of what stock is. Stock is little pieces of paper that are held by typically your broker. They'll hold it in trust for you, so that you don't have to worry about getting it back to them if you want to sell the stock. They've got it right there, and then they just move it in trust to the next buyer. And so the stock market is just a place where all those things get traded.
And quick trading, which I know we're not doing, we're investing.
Right.
But if we were quick trading, we may not necessarily ever have that piece of paper. A lot of these trades are just done on computers now. Is that correct?
That's correct. And actually, we almost never get that piece of paper.
Right, we almost never get it.
Yeah.
It still exists. You still own it. You just might not have that paper evidence, and
Right.
that's okay.
Right. The paper evidence isn't like needed like it used to be. Now they've got the files digital, and they know who owns the stock.
Digital
and you get to
filing.
vote your shares if you have voting privileges, and you never need the stock certificates for that.
Yeah.
So the
Because it
brokers
will be
hold those
attached to your
in trust.
bank.
And so if you want to become a stock investor, sort of the beginning place to start would be like, okay, how do I actually buy and sell stock?
Right.
Or is there something else we want to climb into here?
Yeah, literally. No, you hit it exactly right. How do I buy and sell stock? So
Yeah.
I am sitting here. In the next 20 minutes, I would like to buy a stock.
Okay.
Is that possible?
I'm
What
going
do
to
I
buy
do?
a stock.
So
It
I
sounds
assume-
funny to say, I'm going to buy a stock.
just one.
Just one.
So I assume that there's an account I need to open, right?
Yes.
Mhm.
You need to open a brokerage account.
Yep.
Okay, is that like a bank account?
It's similar
Kind
to
of.
a bank account. And in some brokerages, it has replaced bank accounts because you can write checks on it.
Really?
Yeah.
That's handy.
Very handy. A brokerage account, therefore, is very similar to a checking account, and it's opened similarly. But it's not with a bank. It's with a brokerage company. It's called a broker-dealer. And
Okay.
these broker-dealers are registered with the SEC and are regulated by a private organization called FINRA. And they
FINRA. I'm going to pay that. Hold on. I'm writing not a bank. Brokerage. FINRA. Okay, go on.
are placed, their business is to facilitate the exchange of money for stock.
Okay.
And they take a little piece called a commission whenever they do that. It used to be that when there was no internet, there was a huge commission relative to the amount of stock that was trading. But today the commissions have shrunk down to where they're really, really, really tiny.
Right.
And so this brokerage function has gone from being a hand.
It's interesting that he says that, because I think in the past, selling stock was like a big thing. Like, it was really wealth fulfilling for someone to be able to be the person who traded, was the brokerage, right, person. And now I feel like because the fees are so much smaller on like per trade, that encouraged them to support fast trading or day trading or any of that stuff, because the more people trade, the more money that they're going to make, right? So it's very interesting how these like loops can like be affected, and you, just because they make less per trade, you don't want to get sucked into trading more often because they want you to do that so they can make more money. You know what I mean?
Go down to a brick and mortar place, and there's your broker, and
Yeah, there
you
used to
exchange
have
money.
to be a guy who gave a piece of paper to another guy.
Exactly.
And then the sale would be done.
And they would run paper around
But
New
now
York
it's
to
just
get
a fucking
traded and all
computer.
this. And you had to, if you were in the business, you had to be in New York.
Maybe
because
somebody
that's what
checking
paper
up on
was,
it.
And all this has become completely distributed now. It's all completely digital.
It's an extraordinary democratization of the public markets and of the little guy, of us being able to have access to them.
Yeah.
It's really incredible what the internet has done.
It's revolutionary.
It's revolutionary.
Absolutely revolutionary. In both the massive reduction in the cost of actually being in the business of investing, and in the incredible distribution of information. Unbelievable now that the little investor has access to virtually all the information that the big investor has access to. This is one of those places where, I'm not a huge fan of regulation in most cases, but this is one of those places where regulation has really had a great impact for the democratization of information by requiring that no one get the information before everyone gets the information. And it was impossible to do that before the internet.
Okay.
So there's always somebody that got it first, and whoever
Right.
got it first had a huge advantage, and it was always
Right.
a big guy.
Mhm.
Well, today,
The
everybody
richest
gets
person.
it first. And now the advantage has shifted, ironically, to the little guy. Warren Buffett has been asked, for example, why didn't you get out of these stocks when they were really high and then they dropped like a brick? And he said, we're just too big. We're not nimble. Like, we can't
Right.
do that. So the advantage goes to the little guy, because if everybody's getting the information at the same time, then the guy who can move all of his money quickest and easiest has
This
a
is
huge advantage.
person with less
So
money.
if you're working with $1,000, you've got massive advantages over a guy like Warren Buffett who's working with $100 billion
Right.
in the ability to move it around. So, okay, so the brokers.
So there's a brokerage account that each person needs to open.
Yep, and it's just, you can do it right online. It's really easy. And to find the brokers that are out there to work with, you just Google stockbroker, online stockbroker, and that's virtually all of it's done online now. We
There
all
are
are
probably
online.
a lot of them.
And there's a bunch of them. I can give you a handful that I know are pretty good.
Yeah, that'd be great.
Okay, so there are some sites that are real professional, and then there are sites that are more for the amateur investor.
What
And
does that mean? What's the difference?
the difference is the amateur is going to pay a lot more
Yeah.
per trade,
That's
Right.
not good.
which sort of is too bad.
Are you getting more for that extra payment?
A little
No.
bit. Yeah, you are.
You
You
Are
get
you?
help or something?
Yeah, you get a little more help, and you get a lot nicer interface. You get one that's a lot nicer to work with.
Simpler.
The professional sites
Which
tend to
probably means
be
it's easier to work with.
easier to work with. I'm thinking in particular one of the sites that I use is Interactive Brokers, which is just full-on professional website. And oh my gosh, can you ever screw up on that one? If you don't put a minus sign in front of your order, you could end up with exactly the opposite order that you put in. And the minus sign is not intuitive. It's like you need to know that. It's a little bit like working
Yeah.
with the internet back in the old days,
Right.
where it was all DOS commands and stuff. Yeah, you miss one letter, and
You
you
put
got
the
trouble.
forward slash instead of the backward slash.
Yeah,
It doesn't work.
It doesn't work. And so this way, something happens, but it's probably not what you wanted. So Interactive Brokers is, and they're not focused on gathering assets under management from a lot of mutual fund people or something like that. They're not interested. They want pro traders. That's their whole
Okay.
thing. But really
Pro
fast execution,
traders.
really command of
We'll look
markets
into
all
that
over the
later
world.
when we're much
it's
better
quite
at
good.
this.
And pretty cheap. It's like about penny a share kind of thing. You can as an individual investor that doesn't have a lot of money in it, you can probably buy most of the stock you want to buy for about $1.
Wow.
Yeah, that's a
That's
great
really
commission.
cheap.
How?
Great
So for
commissions.
people who are listening to this, because probably people who use Interactive Brokers don't need to listen to this podcast about what a stock is
Yeah,
and
probably not.
how to open a brokerage account.
Well, you're probably not listening to this.
So what are some sites that are a little more friendly towards an amateur?
Yeah, and honestly, I wouldn't recommend Interactive Brokers unless you really want to study it and be really careful. You know what you're doing. They're
Okay.
not looking for your business, and they want $10,000 minimum.
I'm going to make a
before they'll
note.
even open an account.
Must study.
So there you go. The sites that are looking more for the amateur investor are sites like TD Ameritrade, Schwab, and Schwab, TD Ameritrade, and Scottrade.
So basically the stuff you see advertised.
Yeah,
on TV.
E-Trade, Scottrade. TD. Now I haven't used Scottrade and E-Trade, but I've definitely had accounts with Schwab, and I've definitely had accounts with TD Ameritrade. TD Ameritrade's owned by TD Bank.
Schwab.
They definitely have an interest in mutual.
And I specifically did some research for people who are looking for no annual fees, that have if you're not investing your money right in a way, that it has a higher percentage for your money just sitting in the bank account, and that is Fidelity. And then there was one other one that we were looking at, and I can't remember. It was started with an I or something like that.
funds and assets under management, so they're happy to get the amateur investor almost no minimum to open an account there. They have lots of free to look at for business information about companies that you're looking at. So we use them as a research site regularly, and I do have an account open there. They're about, I think they're like $8 for a trade. So
that's substantially different from Interactive Brokers.
yeah, it's pretty different.
But with the added protection that you presumably will choose the correct
You
thing.
might get what you think you get.
Yeah.
Right. And then they
And
have
if you're doing if you're doing this investing the way we're talking about it, you're not making a lot of trades.
right. So it doesn't
maybe it
really
doesn't
make that big a
matter
difference.
that
It does matter to the really little guy. Like if somebody's coming in here and starting this with $1,000,
Yeah, then
that
$8
difference
is a
makes a
lot.
difference.
Mhm.
You remember when you first started doing stuff? I remember you were like splitting up your couple $1,000s into several different stocks, and each time it was a trade, and you had to pay the $8, and it's like,
I know, that was right after college, and I decided that I was going to invest. It was ridiculous.
It didn't work
and I remember being like, wait a second, this commission is eating up all of my money, and you were shocked because you had never traded with so little money.
Exactly. It never occurred to me.
It never occurred to you.
Oh my gosh, $8 is a
And then
lot.
I quit and haven't touched it since.
Yeah, I mean, effectively, I think in those days it was $9.99, which is $10 on $1,000, which is 1%.
Yeah.
So you're paying 1% up front to get in and 1% up front to get out, and which means you have a 2% load on that company.
Right.
And that's the old days. That's what they used to charge in the old days for all these things. And that's when brokers were rich. So that was.
Should somebody looking at the different sites obviously compare the cost and then try to figure out what they're getting for that commission cost? In other words, should they just make a pure price decision? Should they be more focused on the tools that they receive on any given website, or should you just kind of decide which one is more important for you?
Yeah, I think here's what I would do. I get the top 4, and I would call each one of them, or maybe that would be TD, Scottrade, Schwab, and E-Trade, and call those guys and see how their customer service is for you. I haven't interacted with customer service for a long time, so and that's what you're going to want to do. You're going to want to have a guy on the phone that you can talk to.
When you're new to something, you need some help.
Yeah, and if you're just doing it on the internet, it's easy enough once you've done it a couple times. But the first time, you know how it is. Yeah. You start to get lost. So you need to be able to have somebody who will respond quickly, and you'll have to find out for yourself which ones are better. But that's how I would do it. In terms of the tool sets, I know TD's tool set's really good. They've got a lot of stuff in there, which you may take advantage of. A lot of analyst reports, a lot of information about stocks is all in there. And as you're doing your research, that might be a good place to go and get that stuff. And you can open up a TD Ameritrade account with no money.
Really?
Yeah, you can open up a legit account and not fund it and have full access to all their goodies.
Well, that sounds really cool.
Yeah, it's pretty cool.
We're not trying to advertise them, but that sounds really interesting.
I don't know
that sounds actually like a really good first step. We were debating what really the first step should be when you start thinking about investing.
Well, cool. Then and we don't have any kind of any relationship with TD Ameritrade, so I'm perfectly happy to have you guys go over there or anywhere else. And I think maybe if I was just going to recommend one, I know that they have good stuff.
So a lot of other ones have minimum account balances that you have to put in initially.
A lot of them do. I mean, and a lot of these websites really want options traders. They're not interested in assets under management.
That's how they make money. Because you're constantly paying commissions on that stuff.
It's the commissions from options traders. And TD American has an option trading wing called Thinkorswim. And if you ever got into options, which is something fun to talk about someday, that's not a bad site to do it on. A little bit expensive, but not horrible. And I think for that reason, TD Ameritrade keeps everything available to you for free because ultimately they want assets under management. And assets under management are a big advantage for a company that has a bank that owns them, that does 2/3 of its revenue from mutual funds. So they occupy this sort of interesting position where, come on into us and trade or invest, but we're happy to do it for you. And I think what they've found is that that's really an effective strategy, that we're happy to have you come on board and really come out to be an investor because you're going to figure out real fast
that you need help.
That you need to just give us your money. We'll take it from here.
And maybe you should just switch your bank account to us as well.
Exactly.
So much easier to have everything in one place.
And we can write checks against your account. You can put your IRA in here.
Interesting. It looks like TD Ameritrade might be.
So they've made it very, very flexible. And hey, man, if all you need a bank account for is to write some checks.
Schwab now.
I know, man.
Charles Schwab and TD Ameritrade
you want to check
are
and
one
make sure that
thing.
these guys are insured for plenty of money. And TD is vastly insured, so Schwab, so is E-Trade and Scottrade. So they're all like insured for millions, not like your bank is like good FDIC for like, what is it, $250,000 now, 400,000, something like that.
500,000.
These guys are millions of dollars. I think 20 million or something. So you can put all your money in one place.
Yeah, I think you can get a TD bank account, but
they execute the trades
to trade,
so
they're part of Schwab now.
There's an option to not execute trades well.
Well, understand that the way the market's set up is that there's a limited number, let's
Unsolved
say, I don't know, 15 or
mysteries
20
too.
places
Said.
where the
Here
stock
we
is
go. Come
literally
with me.
exchanged.
There's a world out there that we should see. Take my hand, close your eyes, we go right
Hello,
here.
how are
I'm
you,
a
Unsolved
rocketeer.
Mysteries?
Let's fly. Woo hi.
That's a good song, by the way. I can't remember who it's by, but I remember. I'm trying to find TD Ameritrade right now. Let's see. It keeps bringing up Fidelity first, and then when I click on it, it says www.tdameritrade.com. It goes straight to Charles Schwab, which is very interesting. It looks like the company is still around. Like, they have banks, TD Ameritrade, Investment Services, Financial Consulting. And it says here TD Ameritrade, American Online Broker, TD Ameritrade Corporation, was a stockholder of that offered an electronic trading platform for the financial assets.
Unsolved Mysteries 2.
For securities.
It's a song called Rocketeer by Far East Movement.
Yeah, Rocketeer. That's the song. So, I don't know. Trade. Is it owned by Charles Schwab? Let's see what happens. Partnership TD Ameritrade considered the following points. TD Ameritrade is indeed owned by Charles Schwab. The acquisition was completed in October 2020. Schwab purchased TD Ameritrade for approximately $26 billion. The merger aimed to create a larger brokerage firm with enhanced services. Existing TD Ameritrade customers continue to use the same platforms during the transition. The integration of services is ongoing with plans for a unified platform in the future. Yeah, so they're not letting people make new TD Ameritrade. Like, you can't get TD Ameritrade. They are now Le Schwab or Charles Schwab. They were combined. So, that's interesting. How are you doing Unsolved Mysteries?
Money. They're called primary brokers. Then there's a lot of other guys who are out there collecting all the clients who do all the trading, and they make a nice interface. But when it comes time to actually do the trade, it's going through somebody else. And I'm pretty sure TD Ameritrade's like that. They don't actually do the trading, and so it goes through somebody else. Now,
Doesn't matter
if that's the
anymore.
case, you
They're
want them
part
to
of
have a lot of
Charles
somebody
Schwab.
else's they can go through and get the very best price every time for you as possible. And so we often look at that and try to compare what price do we get on that stock for that company versus this one for this company. We do it for options regularly, and we find that some places are much better than others.
For
But
someone
TD's
doing
pretty
long-term
good.
investing,
Yeah.
is that really a major factor? If maybe you're off a penny or
No, being off a penny is irrelevant.
Okay.
Yeah, I wouldn't worry about it. In fact, there's this book that was written called Flash Boys by Michael Lewis, where he was getting a little bit.
I'm going to write that down just in case we want to read it. It's called Flash Boys by Michael Lewis. I'm just going to circle that. Book. Read. Okay.
Hysterical about the fact that there are some companies that inserted themselves in the electronic signals that were going from somebody that was 5 blocks away from their prime broker. These guys would pick off that signal and then front run it. And we're talking about milliseconds here. And Michael Lewis was like, yeah, and then these guys like Bill Ackman came out and they built their own system so nobody could front run them anymore. Okay, well, that probably affects Bill Ackman in a big way. Okay, having somebody front run him and kick the price up a little bit by a half a
because
penny.
he's someone who's managing
$8
hundreds
billion.
of millions. Oh, $8 billion.
Yeah.
So when he's moving $8 billion, like he stepped in on Herbalife and he put in an order for millions of shares, and if they're front running him on a penny times 1 million shares, that's somebody's $10,000 payday.
Yeah.
Right? Not Bill's. Some clown in a business office that just got clever, and so he figured out how to shut that out. But the Flash Boys was more about how look at how Wall Street's ripping off America, and it really doesn't have an impact on a retail investor at all. You only put it in one order. It's done. Nobody cares.
Do you have to pay the commission when you purchase the stock and when you sell the stock?
Mm-hmm.
So
You
you
pay
pay it
commission
twice.
going in and going out.
So really, for me, let's say if it's $8 for me to buy and sell a stock, I'm paying $16.
Yes.
So I need to account for that
When you're buying
thinking about what I'm buying and how much I'm putting in and how much I can. I mean, in a way, you've lost $16 straight off the bat.
Yep, but it's $16 period, not $16 per share. So it's just $16. So if you were an investor with,
I wonder what the
$1,000, it affects you. It's 1.6%, right? So $1,000 is a little bit tough to do this kind of investing with. And we basically try to do, if I'm working with $1,000, I'm going to do more leverage kinds of trades. I'm going to do options instead of long-term stock investing until I've built up my portfolio upwards toward about $100,000. And then everything above that starts to get pretty big for the options trading market, actually. And you start to move the market around a little bit. So everything above that, you go long-term with. So that's kind of what we would recommend is if you're starting with a really small amount of money, what you do is you find really wonderful businesses that you understand that have big moats that fit everything Charlie Munger and Warren Buffett are talking about, and they're absolutely on sale. But instead of buying the stock, you do options trades. And I know I'm way over into the weeds here, but I just want to tell you.
I think that's kind of the opposite of what we've been talking about, though, which is being a first-time starting out investor. Oh my gosh, this whole thing is crazy. You probably are that person who doesn't have $100,000 lying around.
Yeah, really true.
But suddenly you have to leapfrog to a much more complicated system of investing.
You probably would benefit from that. I'm just thinking you probably would benefit from that because it gives you a potential for a lot higher rate of return if you do it well.
Mm-hmm.
And I'll tell you right now, Danielle, if you know the value of the business is well above the price of that business, it gives you an advantage on an options trade that isn't baked into the pricing of options. And it gives you an edge. And when you have an edge in a betting market like that, you can really do well with it. And so, we pretty regularly see people taking, a few $1,000s and turn it into really serious amounts of money because they understand the ideas that Warren Buffett and Manish Bhai are talking about, and then they apply them to a more leveraged situation than that.
Options can have a very intense downside, though. And I think, tell me if I'm wrong, I think most brokerage companies won't even let you open an options account without either a certain amount of money or some experience investing.
Right. They want to see that you have experience investing, and it's very smart that they ask for that, because options done wrong.
Okay, so Microsoft says, in terms of the costs, online trading fees can range from a few dollars as much as $20 per trade, $20 per trade, depending on the brokerage. These fees can be associated with stocks, mutual funds, or ETFs. The typical fee for option trading is 65 cents per contact. I'm going to say for Fidelity specifically, trading U.S. stock and EFTs online with Fidelity costs $0 per trade, while option trades carry a 65% contact fee. Online stock and ETF trades, Fidelity, 0 commission for online U.S. stock and EFTs with no account minimum, no per share fees, and no monthly limits. They applies to both full and fractional shares, making it accessible for investors with smaller balances. Fidelity supports buying as little as $1 worth of stock. Okay, so that's one reason why I picked up Fidelity. I was wondering. Okay, so this is a big thing. Is there are some where you might be, that's why it's really important that you pick a good brokerage for your situation, because you could be paying up to $20 each time you trade. Whereas like in Fidelity, I can trade all day long, dollar here, dollar there, dollar here, dollar there. No big deal.
And you wipe out your money really fast. And so you'll be the Patel family, but no Modell. You'll just wipe it out in a matter of months and you're gone.
So
but it's a misnomer to think that options have to be really risky. I mean, I've listened to people teach options for years, and they try to play this little game that, options are safer than stocks because you can only lose the money you put into the option, all of it. And how exactly is that safer than a stock? And what they say is, well, an option for IBM only costs you $4, but the stock costs you $160, and you could lose the whole $160 in the stock, and you could lose the $4 in the option. So which one's riskier? Obviously, the $160. Which there's something fundamentally massively flawed with that logic.
Yeah.
First part of it being that you wouldn't even be touching IBM if you thought it was going to go broke, right? That there was any chance that IBM was going to go broke. So the idea that you're comparing an option against a company that isn't going to go broke, apples to apples, is stupid, because if you're wrong on the option timing on that option, you are going to lose your $4. And in fact, you probably will. So it's just kind of bizarre how they teach this stuff. But I will tell you this, without getting too deep in the woods on options here, that if you are a ruler type investor, rule one focused investor, and you've learned to invest the way Charlie was talking about, understanding the business, the mode of the business, the management of the business, and margin of safety, if you've learned to do that, then when you do options, you can absolutely do them in such a way where no matter what the stock price does, you win. There's no losing. Now, I know the SEC just had a heart attack when I'm talking about options with no losing, because they're considered to be very risky. But let me just tell you that there are certain kinds of options that you can do where essentially if the stock price goes up, you keep the money that someone paid you on the option. If the stock price goes nowhere, you keep the money someone paid you on the option. And if the stock price goes down, you get to buy the stock at the price you want to own it at. So no matter what, up, down, or sideways, you're going to do fine. And so I would basically, maybe someday we'll talk about that and how you do that, but not now. I mean, just want to say that it's possible to get stock at a big discount. Warren Buffett does it all the time using options on a regular basis to get you into the stock at a price.
Not anymore, I guess. Maybe he still does.
Again,
a bit,
without telling you how we do it necessarily.
Company.
Whole Foods went from 60 down to 38 not too long ago. And on the news that John Mackey was saying, hey, we're going to cut prices and we're not going to be as profitable as we were. So it went down to 38. And I thought I would really love to buy Whole Foods around $29 to $30 a share. So I was hoping it would go down there, and it floored up. It just stopped going down, and it's going along at $38 a share. So I used options to manufacture. I bought a few thousand shares of Whole Foods at $38 a share, and then I manufactured a much lower basis by selling options. And the end result was that no matter what happened to the stock price, up, down, or sideways, I would own either the small number of shares I started with at $30 a share or a larger number.
That's actually something, this options things that he's talking about right now, this is actually something that I went to his 3-day weekend course at and learned a lot from. I have notes and everything from it, and hopefully we'll be doing, the big thing right now is that I haven't fully valued a company and found one that's like on my, for sure I'm going to buy this, for sure I'm buying it at this price situation yet. But once I do that, I can start doing the options. Which is why I'm still like educating myself, because I'm working on doing those things, but I don't feel like I fully understand how to value a business yet.
At $30 a share. No way was I over $30 a share. So using options is cool. You can really manufacture some amazing, great margin of safety prices for yourself that guarantee you some sort of profit.
Yeah, because having to own that stock at a low price is generally seen as a loss, but you're actually wanting it at that price, and that's how you see it as a gain.
I wanted it at that price, and so in this particular case, I dropped the basis from 38 to 30 by collecting premiums on options that had a strike price of 30, and I would get put a block of stock at 30. I want to buy it at 30. If it goes to 26 and I can buy it at 30, I'm a happy guy. So I had the stock at 30 either way, and of course what happened is it ran back up into the 50s now. But look what happened. I've got that stock I wouldn't have bought it at 38.
Mm-hmm.
I ended up with a basis of 30, and now the stock's at 50, which is about a 60-70% rate of return in less than a year. So you can create some really good situations for yourself if you know what you're doing.
Okay, and the first step is to create a brokerage account.
Wow, did we ever go into the weeds on that? First create a brokerage account and then start doing really, really sophisticated options trading.
Don't do that.
Yeah, don't do that. Let's start one step at a time and first figure out how to buy some stock.
Yeah,
Right,
and accumulate some savings. It sounds like you really do need a good amount of money to start trading. To start investing.
Yeah, start investing. You
Yeah.
want to have you basically the idea is you want to get going on it.
Yeah.
But here's a really cool thing. Some of these sites have paper trading accounts that you can use.
The fantasy trading.
Fantasy trading. And Thinkorswim, or TD Ameritrade's one of them. It's got this sub website called Thinkorswim, and the Thinkorswim website has a paper trading account. They call it Paper Money, and they give you a fictional $200,000.
Oh, that sounds fun.
Yeah, and it's totally cool. And you
I should do
see,
that.
you absolutely should do that.
Yeah.
And you see the real prices and the whole thing. And it requires that you use the website exactly the way you would use it
So you
with
get
real
used
money.
to it.
So you get used to it. You can get over the intimidation
Yeah,
factor
yeah.
of, oh my God, if I push this button, did I just lose my $1,000? Well, you can push it and lose 50,000 of the fake money, and they'll give you more. You know, so this is a great way to get to learn the website. And I think most of
Probably
these
the
guys
other.
have it.
Yeah, I bet they have other ones that are like that.
Yeah. So you got your $200,000, you got your website, you got your account open, and let's say you don't even have any money in the real account. Now you've got the paper money account open with $200,000 of pretend money, and you are now going to buy a stock, right? Because you've done all this other stuff that we'll continue talking about here forever, about understanding and moat and management. You did all that. You found a thing that's got a great value, far above the price, and now you want to buy it. So using this paper trading account or paper money, you will go in and select the buy button. This is really this simple. You look at your account, you put in the name of the stock you want to buy,
Okay.
And there's a code for each company.
called a symbol for each company.
Symbol.
And the websites, if you write in the name of the company, they spit out the symbol.
Mm-hmm.
They all do it. So if you don't know that
That's very
symbol,
helpful.
it's very helpful. They want you to
Sometimes the
invest.
symbols relate to the company name, and sometimes they don't.
Oh, exactly. There's a company called Horsehead Holdings. The symbol is zinc. How do you get to there? Right? It happens to be in the zinc market. IBM, the symbol is IBM. So there you go. So you put in the
Google?
symbol. You
Goog.
type in the name, but it's going to require you put in the
Pretty
symbol.
sure
You put in the
G-O-O-G.
symbol, or it puts it in for you. And then you select the number of shares that you want to own. Well, how do you know how many shares you want to own? And the answer is, let's say you got your $200,000 pretend account. You decide you want 10% of your account invested in this IBM.
Okay.
Let's say. Okay, so what is 10% of 200,000?
20,000.
20,000. All right, so now you know you're going to buy 20,000 shares of IBM. So you get out some
No,
sort
you're
of,
gonna buy
sorry,
$20,000
$20,000 of IBM
Of shares.
worth of shares. And so you get out a calculator and you look at the price of IBM right now, which is, let's say, 163. And you divide 163 into 20,000. Let me borrow your pen.
I don't know how
I'm
much
going to do it
that
right
is.
now.
We
with
of
my
course
own-
had to pick 163
Yeah,
instead of a lovely number
163.
like 10.
Exactly. But I'm doing the math here. 163, and it's that 0, so 2. Let's just call it about 120 shares of IBM.
I will
Okay.
believe you.
Ballpark.
I will believe
So
you.
let's do the math here. 120 shares times 163 is 0, 6, 12, 3, 163. And that's 06591. Yeah, that's $19,560. Okay, so you say, all right, I want to buy 120 shares. You find that from your calculator. Divide the price of the stock into the amount of the chunk that you're going to put into this company.
The total dollars
Total
you're
dollars
gonna
in.
spend.
And you get, in this case, the number of shares of IBM is 120. Great. Now, you put 120 in where it says number of shares into that little box. And then in all the brokerage sites, it'll say, okay, what kind of order do you want to put in? So the next little box is an order box. And it's going to say, do you want this to be an order that is just for today? Or is it good until you tell us you no longer want to buy it?
What does that mean?
Well, it means that the order will last longer than the end of today's market. That the broker will keep it in there if for some reason they can't provide you with the stock at one, they can't find 120 shares at 163. Wait, let me back up one step.
You have to put in the price that you want to purchase it at.
Exactly. Now, let me say, probably in most brokers, there's an order that follows this way, and that is that they want to know the kind of order you're going to place. Is it a market order, in which case they will simply go get it at the best price they can?
Okay.
And that might be a little higher or a little lower than the price you're seeing currently.
Yeah, it could be. Just depending on how
Market
fast the market's moving around and stuff.
Order.
It could be. But with a stock like IBM, it's going to be within the, pretty much the range that they show. Like on all of the websites, there's a simple little thing called bid ask, and there's a different price under bid, and it might say 163.10, and under ask it says 163.11. So $163.10 is the bid, $163.11 is the ask, and if you say give me the market order on this, they will sell you that at 163.10, unless it's moved around. So they're not going to give it to you at the 163.11 price. That's what. If you're buying, they're going to give it to you at 163.11. Excuse me, they're going to give it to you at the higher price.
Right.
If you're a buyer.
At the ask price.
At the ask price. And if you're a seller, they're going to pay you 163.10. So that little difference in there is what
Interesting.
the broker does to get a little spread, to make a little money right there. All right. So if you put in a market order, you're going to get the worst one of those two prices probably. You with me so far?
Yeah, absolutely.
Okay. And the market order's symbol is MKT, and that means market order. Now, almost all sites default to something called a limit order. It says LMT. They default that way. So if you're going to do a market order, you have to change it by clicking on it from a limit order to a market order. Okay? Now, a limit order is defaulted to because that's safer for the buyer or the seller.
Okay.
What the limit order says is, I am going to give you a contingent order, Mr. Broker. I'm going to put in the amount of money you have to get this for. You have to buy this for me for, and you can't spend any more than that. This is the most you can spend.
The highest amount I'm going to offer.
Yep. So if you put in $163.09, then your broker will not sell it to you until they can get somebody to do the deal at $163.09. And if the market is $163.10 by $163.11, you're not going to get anything. It might be an hour later or maybe never.
Can you put in a time limit on that limit order?
Most definitely. That's where you
Give
put in the
them
time
a day,
limit.
give them a week even?
Yep.
Can it be whatever you want?
Yeah, you can get sophisticated, but the basics of it are you can put in a day order, and it defaults to that, and at 4 o'clock that afternoon it cancels.
When the market closes.
When the market closes. And if you want to leave that order in place, you put in a GTC order. So you click on the day thing, little place where it says day, and it'll give you a drop down, and one of the choices will be GTC. That stands for good till canceled. And it doesn't mean literally forever. Each website has a limit on how many days out that really means, but it means days. It's bunches of days that you can leave that in place. And when this thing ever goes to 163.09, boom, you'll be notified you just bought that stock. So almost all of us use day orders because why sit there with it overnight?
Right.
That's when things change, right?
Yeah, you don't know what's happening with the news after the market's closed.
Right. So you're sitting there with an limit order of 163.09, and the thing opens up the next day at 162 or something. And yeah.
You'd rather have it at 162.
Yeah.
You'd rather have it at 162. You just went to the upper end of the market there. So they'll probably try to get it near 162 when they open the market, but you're vulnerable to be paying 163. So we always pretty much just use day orders. So those are the essence. So you put in, if you put it on market order, then they don't need you to put in how much you're willing to pay. So that's going to blank out. They're not even going to ask you because a market order says whatever the ask is, or if you can do better than that, great. But I'm happy to buy it at that higher price.
You just want the stock.
I want the stock.
Whatever it is today.
Yep, give it to me. And when you've got 163.10 bid by 163.11 ask, just put in a market order.
Yeah, it doesn't.
What the
For
heck?
a stock that's traded as heavily as IBM, it's not really going to make much of a difference over the next half an hour.
You're not trying to get a penny.
Again, unless there's news.
Right. You're not trying to get a penny. Now, you can put in any kind of a price. You could say, make a good deal canceled, and if IBM goes to $140 a share, I want it. And you can put that contingent order in there. You can do all kinds of lovely things. I mean, they have really sophisticated algorithms that you can create with if-then scenarios, including on percentage bases and all sorts of things that you can do. But for us right now, let's just do the basic of, all right, we haven't even funded our account, but
I didn't know any of
we're
this.
using pretend money, and we're starting to learn how to
All of this about the market order, MKT, and limit order, that's all new to me. All of it.
use their tool set without having money at risk.
I'm writing all my
So
notes down
that's the
about
key
it.
piece of this.
So that way I
we'll come back
remember.
next time, we'll talk a little bit about some more cool things you can do on that brokerage site, and then when do you know you should start thinking about using real money?
Yeah. This is much
Yeah.
clearer.
When should you
That I thought it
know
would be.
when
I
to
have to say.
start using
My
money?
goodness.
It's really important.
That's good news. This isn't
Not
always
just
that way.
fake
No,
money.
I think there's something beautiful about having the veil lifted a bit and seeing how it works behind the scenes.
Well, I'm really probably going to get in trouble with my peer group because, they live and breathe on obfuscation and fog. The
Oh,
more you don't
gosh.
know, the better it is for the financial services
There
industry.
are evil people wandering around going, we must obfuscate. Come on.
Listen, if you think for a second that these guys are in the business of making it easy for you to understand what's going on, you are naive. They make
I'm in the
$100 billion
business.
a year.
I'm in the business of making it easier for you, and that's why we're doing it this way, so that you guys can learn the easiest way with me as I'm learning how to do this.
On your ignorance. That's
right.
a
They
lot
make
of
money. Mhm.
A lot of money. That's the amount of money spent.
Who is that? Who is they? Who makes $100
These are the
million?
They.
mutual fund industry. So Fidelity,
Mhm.
Janus, all of these big mutual funds, all that stuff that TD owns, huge mutual funds,
Mhm.
have $100 billion a year that they make based on fees that you shouldn't be paying.
Yeah.
But you don't know that because we haven't
Mhm.
talked about that much yet.
No, we haven't.
But we will go to some experts like John Bogle and.
But
Lutz Van-
we've talked about it a little bit through the book of Invested and a little bit outside of that.
Vanguard
So
funds and have him explain for us why he thinks it's such a ripoff.
There's so many things to say.
there's so many
excited.
things to say.
Well, I guess
All right, guys, that was pretty good. I enjoyed this one quite a bit. I took quite a few more notes comparatively to the last 13. So I think we're starting to get into the part where I'm a little more ignorant, a little less knowledgeable at, and that's really exciting for me. I do love learning, and I'm really happy to have learned this very specific thing about market orders because, man, a little part of me was like, maybe this year I'll start investing, but just learning the fact that I didn't know that really, really shows me how much more I need to learn. And I think that's a big thing to know is knowing how much you don't know. So without any other things to make note on, If you find this on YouTube, don't forget to like, share, and subscribe. Hit that bell icon down below so that way you know every single time when I post. And leave a comment down below, guys. What were you feeling about this one? How are you feeling about, does it make you feel a little bit more relaxed about looking into picking out a brokerage account now that you know a little bit more about what you're looking for? Did you know what you were looking for when you were going to open a brokerage account? Or were you just going to look up whatever was the most highly rated one on the internet? And was that one that was going to be good or negative for you? Let me know. And until next time, bye.